Stephanie, what's caught your attention today, if anything?
Well, it's actually this week, because we always talk about the macro data. It's super important for earnings, rates, the Fed. But this week we learned a lot about the micro, about fundamentals, about what companies are saying and what they're seeing. And I just want to give you a couple of examples. GE increased their aviation sales for 2023 by 11% higher than where the street is at. And believe it or not, the stock is down today, which is silly. American Express, during this week at a conference season, they actually raised the high end of their guidance for 2022 because T&E, travel and entertainment, is actually stronger than expected. And David, we haven't even seen business recovery yet. So I think there's real upside to that name. Marriott is opening 30 luxury hotels next year. That's higher than expected because of demand. And then we had a whole bunch of shareholder-friendly actions in terms of dividend increases and buybacks. Zoetis, CVS, Stanley Black & Decker, they're also making an asset sale, Carrier. So while I think the macro is always important, it's on days like the day after Thanksgiving, when stocks get hit really hard, I go back to my notes and say, I want to own all of these names because they're doing really good things. So I think that's really what the theme for me this week was.
Yeah. Okay. Well, stay right there, Stephanie. I want to get to our friend Jim Cramer, of course. He held a special event today where Investing Club members were able to ask him about his best ideas for the new year. Here's Jim talking about one of his top picks. It's Disney. And he says he bought more today for his charitable trust.
I think Disney is way overly hated. Some of it's just worries about the pandemic. Some of it is a belief that maybe management isn't as strong as it used to be. I have to tell you that when you have an iconic franchise like Disney and you can buy it 50 points below where it's been, I say you start buying some.
Down 15% or so for the year. Jim, by the way, also recommended Wynn and Wells Fargo. I know, Stephanie, you agree with him on those, I believe.
I agree with him on Wells Fargo and Wynn. On Disney, I don't. I just don't think there's a catalyst. And last year, David, the stock re-rated because of Disney Plus and subscriber growth that beat expectations. They're the beneficiary of a stay-at-home, of course, right? So fast forward this year, they missed on subscribers for Disney Plus Core. They only came in at 4 million versus 10 million, and they're still guiding to the same numbers by fiscal 2024 in terms of sub growth. But they have to spend a lot more money getting there, more than the 8 to 9 billion that they initially gave us guidance on. So I think, by the way, then the core business margins are under pressure because of heavy investments. And so I think it's probably not going down a lot more from here, but I just don't know if there's a catalyst. And by the way, it trades at 38 times earnings, and the sell side has 75% of them have buys on the stock. So I just think you have time on this one.